There's a nearly $370 million deal that's making serious waves in the fintech world. And it all comes down to one of the most powerful assets in all of finance, a national bank charter. Today, we're going to unpack how an online lender called Enova is trying to completely change its own game by buying a digital bank, and what that might mean for everyone else.
Yep, that's the number. $369 million. That's what fintech lender Enova is paying to buy Grasshopper, a digital bank. And you better believe this move has Wall Street's full attention, for a very, very good reason.
All right, so let's break this down. What's actually happening here, and who are the players involved?
Okay, on the surface, it looks pretty straightforward. You've got Enova, a big online lender, buying Grasshopper, a digital bank that happens to have that all-important national charter. But the real story here, the thing you need to focus on, is the outcome. Enova isn't just buying another company, it's literally transforming itself into a bank holding company, which means it'll be regulated by the Federal Reserve. This is a fundamental change to its very DNA.
So why would they make such a massive move? Well, Enova's play here is part of a much bigger story that's been unfolding in the fintech world for years, this relentless, almost desperate quest to get a bank charter.
And this is really the core question, right? For years, the fintech model was to partner with existing banks to get things done. But that's changing. Now, the goal is to become the bank. So, why the big shift?
I love this quote because it just nails the motivation perfectly. It's a callback to the old story about the bank robber Willie Sutton. Why do fintechs want to be banks? Well, for the same reason. That's where the money is. And in this case, the money really comes in two main forms.
And those benefits are absolutely massive. First, you get access to cheap, stable funding through FDIC-insured deposits. That's a game changer. Second, you get to escape the regulatory maze of state-by-state licensing. With a national charter, you operate under one set of federal rules, coast to coast. No more dealing with 50 different headaches.
But here's the catch. If it's so great, why doesn't every fintech just get a charter? Because it's an absolute grind. The application process can take years, it's incredibly expensive, and regulators put you under a microscope. Plus, there's no guarantee you'll even be approved. And that is precisely why buying an existing bank with a charter, like Grasshopper, is often the only real way to get it done. You get to skip the line.
This chart really tells the whole story. The old way, partnering with a bank, is getting riskier by the day. Your partner bank could face regulatory pressure and just cut you off, killing your business overnight. But when you own the charter, you're in the driver's seat. You have full control, nationwide reach, and that sweet, sweet access to cheaper funding.
But here's where the strategy gets really brilliant. This move isn't just about playing offense. It's also a powerful defensive play to build a fortress against a rising tide of state regulations.
People have called the bank charter the crown jewel for a reason, and a big part of that is a kind of superpower it has called federal preemption. In simple terms, it means federal banking laws often override state-level ones, and that superpower is becoming more valuable by the minute.
Why is it so valuable? Because for all the non-bank lenders out there, things are getting complicated. States are rolling out this complex patchwork quilt of new rules and regulations, creating a compliance nightmare. And Texas is the perfect example of this.
Just look at this. A new law in Texas heaps a bunch of tough new rules on non-bank lenders. But then, look at the column on the right. Bank holding companies are exempt, exempt, exempt. By becoming a bank, Enova essentially gets to sidestep this entire mess, building a regulatory moat while its competitors are left stuck in the mud.
Okay, so that's the strategy. But what does Wall Street think about all this? What's the verdict from the market? Well, the numbers are pretty telling.
The reaction from analysts has been incredibly positive. They're using words like transformational. You're seeing price targets climb across the board, with some analysts seeing the stock going as high as $199. They're basically betting that Enova can use this charter to become the go-to digital bank for non-prime customers. And what does this mean for the bottom line? Well, Enova is projecting that this deal will boost its adjusted earnings per share by more than 15% in the very first year. And once everything is fully integrated, they think that number could climb to over 25%. That is a serious impact. Remember that funding advantage we talked about? Here it is in action. By using Grasshopper's deposits, Enova expects its cost to borrow money to drop by over 200 basis points. That's a full 2 percentage point reduction. So think about it. Their borrowing costs could go from around 8% all the way down to 6%.
That's a massive, massive advantage.
And it's not just stock analysts who are excited. The big credit rating agencies are taking notice too. S&P upgraded its outlook on Enova to positive. But the really crucial part is what they said next. Once the deal closes, they're going to start rating Enova like a bank, not a riskier finance company. That is a huge de-risking event for the entire company.
Okay, so let's put all these pieces together. If you were looking at this from a market perspective, what's the potential trade thesis here?
Well, the core idea is pretty simple. The thesis is that the market still hasn't fully appreciated this transformation. Enova is pivoting from being a non-bank lender to a lower risk, lower cost, and better protected bank holding company. The bet is that the stock is mispriced because of this. And the big catalyst to watch for will be the deal closing in 2026, and then the quarterly reports that start showing those savings and earnings boosts hitting the bottom line.
And all this leaves us with one final, huge question for the entire industry. Enova clearly saw the writing on the wall and made a bold, decisive move. So, is this the first domino to fall? Are we about to see a wave of other major fintechs realizing they have to buy a bank just to stay in the game?
This is not financial advice.